All right, hello everyone. So in this video, I want to talk about something that a lot of people actually don't talk about. When you look at some of the YouTube videos online, it's mostly how to either get rich or how to sell everything or how to buy everything. And it's more about making predictions. And in this video, we're just going to quickly talk about the 10 things to consider before you make investing decisions. But actually, we're going to rewind a little bit. What I want to open with is a conversation around what these times can teach us about our own individual stock investment or stock trading plans. Now, I don't know about you, but I will say for myself, my trading account, I have a main trading account that is down actually a pretty sizable amount of money, something like 40, maybe 50% of the amount of money in there. And then I also have the two accounts that I run, the index ETF that I run for this channel, as well as the ARK ETF fund that I run on this channel, where I put in $1,000 just to see how the funds will do in a year's time. Now, however, back to the main account or the larger account that I have, that account is down a large amount because it is actually, as you can imagine, heavily invested in tech companies, and they are individual stock investments with only a small amount of ETF exposure. This is something that I talked about in a previous video that I do want to tweak, and I'm going to tweak it moving forward. And having gone through cycles like this before in the stock market, and I'm going to go ahead and be a little bit more specific when I say cycles like this, I'm going to pull up a chart of the Qs so you can see what I'm talking about. I'm talking about this. I'm talking about going from 400 on the Qs, which is a ETF that tracks the NASDAQ index. I'm going from 400 all the way down to 275. I believe right there is a roughly 30% decline, and this is in an ETF that tracks an index. So this is not even considering single stock companies or single stock risk. Now is the time, because you know what? You can learn more from these times, than you do in these times, because in these times, it's easy money. In these times, you actually, unfortunately, can create plans that are faulty. For example, looking in these times, one might create a plan that says, well, you know what? If a stock drops, 5%, I'm going to buy more because it never drops more than 10%. And I have 2 years worth of evidence to prove that. Those are all facts. If you look at it quantitatively, those are all facts, right? Until it doesn't work. And that's kind of where we are now. So we're in the phase of where it doesn't work. And now, if you're holding and you're still holding, obviously that's a huge decline, or maybe you sold, maybe your plan had you selling up here because you saw the declines and you haven't purchased back yet. It's just good practice to reevaluate your trading. And now there's so much that we can learn as our portfolios are being stress tested. All right, so moving forward, just real quick, the 10 things to consider before making an investment. Obviously, if you're in the market already, then this might be helpful kind of in a, looking ahead. If you haven't invested and you're thinking about doing it, this comes directly from the Securities and Exchange Commission. So this is the SEC. It's not my suggestions on their website, and this is a government agency. So I'd like to think that they have experience in terms of helping to navigate or guide the investment landscape, because these are the people that regulate investment. First one, draw a personal financial roadmap. This is basic. This is sitting down, looking at your entire portfolio, looking at your, it could be your current net worth, assessing your current debt to income ratios, possibly engaging in zero-based budgeting. I have a video that I'll link in this video. If you're interested in zero-based budgeting, is a great tool, but definitely you want to come up with your own financial roadmap and set goals. Everybody has a different time horizon. If your time horizon is 30 more years to work, that's very different from somebody that's retiring in 3 years. All right, then evaluating your comfort zone in taking risk. Same idea. This was specific for, or talks about stocks, mutual funds, but yeah, just thinking about what your risk comfort is, or its risk tolerance. If right now you're holding a portfolio that, like me, is down 40%, you may have either cut losses before, or you may say, wow, this is crazy. I'm never going to do this again. I'm going to sell now. Well, we know historically, if you're in sound companies, that hasn't really been good. However, these are things you want to evaluate again before making your investment. So right now, if you're sitting there and you're sweating because your account is down and now you're like, I can't take on this much risk, those are things we should talk about before. However, if you're in it right now, then these are the times you're going to want to do a hard stop and reassess the situation just to make sure that you're comfortable proceeding or maybe taking a different path right now. All right, considering an appropriate mix of investments. Like I said, I'm going to be making some changes to my portfolio moving forward after this cycle, and I won't be moving to cash or bonds, but I am going to, now that I've done some videos on ETFs, I'm actually going to be looking to invest more on some ETFs in order to diversify and reduce single stock risk in my portfolios. All right, moving on. Be careful if investing heavily in shares of employer stock or any individual stock. And that's what I talked about. Obviously, if you're heavily invested in one stock, let's say you're all in on Tesla. Well, if Tesla goes up, then you're doing well. If Tesla goes down, then obviously you're going down. All right, so the next one, create and maintain an emergency fund. All right, well, I just made a video about this. Critical in times like these, we don't know what lies ahead. If suddenly unemployment hits the entire U.S. economy and people are out of work, well, they're going to be forced to liquidate their assets, which unfortunately, in the context of a poor economy, you're talking about stock market at lows, you're talking about homes at lows, you're talking about the high-flying car market likely being reduced as well. So what that's going to cause people to do is they'll be out of work and they're going to have to liquidate at the very bottom of markets, and that's absolutely a disaster. So having that emergency fund is critical. All right, paying off high interest credit card debt. Yep, that's a good point, because credit card that you're paying interest on, definitely not good. It's hard to save when you have a ton of debt, and you definitely want to have your debt paid off, it's my opinion, before you start investing, because in the long run, at least you'd be tackling this as opposed to holding on to having your money tied up here. And I also have a video about that on how you can leverage 0% APR offers on balance transfers to help you pay off your low interest credit cards. All right, moving to number 7, almost done. Consider dollar cost averaging. Also have a video on this. And this is just where you say, all right, I'm not going to take this lump sum, my $1,000 teacher bonus or my $1,000 sales bonus, and I'm going to spread it out over a period of time. And you can see just on its most basic level, I'm going to pull up a chart of, let's say, Target, just pulling a random company. But you can see at its most basic level that, again, when things are going well, you could spread out money here and you're still taking that staircase up. But you can see how by spreading out some of your money, it could be beneficial. So instead of right here at 235, putting my $1,000, maybe I say I'm going to put $1,000 every week for 10 weeks. Well, now all of a sudden I'm getting at 275, but I'm also getting at 225. I'm also getting at 160. I'm also getting at 152. I'm also getting at 142. So now instead of a full average here at 235, my average would be closer maybe to here at 180. And that would be your dollar cost averaging to consider. All right, 3 more. Take advantage of free money from an employer. Lots of employers offer, 401ks. And that might be something they definitely say. I heard an episode, I believe, of Dave Ramsey where he said he studied millionaires, and the big thing they had in common was they maxed out their retirement plans. They also had a house paid for. So definitely take advantage of any employer match or savings. My mouse is not working today. Savings that your employer offers you. And a lot of them have tax benefits, pre-tax contributions. Talk to a financial advisor, but there's some advantages that you can take there. 2 more. Consider rebalancing your portfolio occasionally. This is especially important if you are somebody that's doing, taking single stocks. In this particular time, you see where being heavily invested in, say, tech or consumer discretionary, you would be losing. Whereas if you had a balanced portfolio of maybe X% of, X% of energy, which is doing well, you have that diversified portfolio, then you'd be better. You'd have a more stable portfolio. You wouldn't have large swings or be down 40%. And then, of course, an ETF, say the Qs, which tracks the NASDAQ, or the S&P 500, the SPY ETF, those have automatically, or they automatically rebalance themselves. So people that manage those ETFs, those are constantly being rebalanced. So you wouldn't have to worry about doing that. So that's something you may want to look to. And then the last one's avoid circumstances that can lead to fraud. And this is actually something that's interesting. I can tell you that when we're in these tough times, it's easy to want to get rich quick or revenge trade or go off that next tip. And we just have to be aware. There's a lot of people on there, they've been doing it for years, where they'll go on and they'll say, oh, buy DMT stock because it's going to go to the moon. Well, those people have already purchased for the last couple of weeks. You're buying in, stock price is going to appreciate. You're buying, they're selling to you. Air gets out of the balloon, you've crashed. So now you've taken, say, $10,000 from a failed investment. You bailed. Now you have $3,000 left. You're like, man, I got to make my $10,000 back. You put it in this fraud or the scam, pump and dump, and now your $3,000 is turned to $500, and now you've lost all your money. So just beware. Again, sometimes it's better to do nothing or to really sit with yourself and think things through instead of just going for that next shiny object, because a lot of times it can lead you to destruction. So I know that was a lot of information, and I know it's kind of intense, but just as a reminder that in these bear markets, officially bear markets, it's important to consider, revisit your trading plan, and maybe make tweaks to it, reflect on it, make changes, so that way moving forward and in the future you'll be able to navigate both the good times and the bad, like what we're in now. All right, so as always, I really appreciate your time. I just wanted to make this video before going to sleep. It's kind of late, but I thought it was important. I thank you for your time, and as always, this is Dr. Diffins signing off. Bye-bye.